Welcome to vTalkInsight, Market Drivers Daily for December 24th, 2025. Markets are heading into year-end, trying to reconcile surprisingly strong growth, an enormous artificial intelligence Capex cycle, and a new round of policy and currency tensions. Let's start with how the growth backdrop is evolving and what that means for risk assets. The growth story has shifted from fragile soft landing to something closer to a genuine reacceleration, led by the United States. Third quarter U.S. GDP was revised up to around 4.3%, the fastest in 2 years, with estimates for the full year near 3.3% and the fourth quarter holding up well. Under the surface, consumer spending surprised on the upside, and productivity gains were strong enough to deliver this output despite the weakest employment growth since 2019. AI-related investment helped too, with spending on data centers, information processing equipment, and software adding roughly a full percentage point to GDP growth in the first half before normalizing. U.S. consumers remain the key engine of this expansion. High-frequency data point to spending growth of roughly 4 to 4.5% year-on-year into the fourth quarter, supported by wage gains and solid credit quality across income cohorts. Airlines are flagging record holiday travel, with daily passenger volumes up and domestic airfares rising about 7%, while live events continue to see secular demand, benefiting platforms such as Live Nation. At the same time, powerful structural themes are boosting nominal growth, from the rapid expansion of the GLP-1 obesity and diabetes market to resilient demand for luxury and secondhand fashion and robust premium travel and lounge usage. Outside the U.S., the growth picture is more uneven but still tilting positive at the margin. Germany is expected to grow around 1% next year, helped by sizable fiscal packages, including a large front-loaded spending push into defense and infrastructure, even if multiplier effects may be modest. European auto demand has stabilized, with new car registrations rising for a fifth consecutive month and electrified vehicles taking a larger share, signaling an ongoing recovery for part of the industrial complex. Emerging markets are seen more favorably when a U.S. dollar is stable or weaker, with a euro to dollar level above 1.15 viewed as supportive for that constructive stance. This mix of strong U.S. data and improving pockets abroad underpins a constructive earnings outlook into 2026. Technology already accounts for roughly a quarter of S&P 500 profits and is growing close to 30%. But investors also anticipate earnings broadening over time, with more contribution from cyclicals, mid-caps, and international equities. On the macro side, recent growth and price data push Treasury yields higher and flatten parts of the curve, and market-implied odds for a near-term Federal Reserve rate cut have fallen sharply, with only a small probability placed on a move as early as January. Lower nominal rates are still expected over time, which would ease borrowing costs for households and corporates, but the timing and magnitude look less generous than markets were pricing only weeks ago. There are credible challenges to this upbeat growth narrative. Interest-sensitive areas like structures and residential investment have been weak for several quarters, suggesting the expansion is narrow and heavily reliant on Capex and higher income consumption. Equity valuations sit near multi-decade highs, leaving limited room for negative surprises if AI investment slows, if consumer spending downshifts, or if the Federal Reserve ultimately delivers fewer cuts than markets expect. Upcoming releases on durable goods, the next estimate of third quarter GDP, consumer confidence, and inflation and labor data will be critical signals of whether this reacceleration can extend, especially because so much of it now hinges on the AI Capex story we turn to next. Artificial intelligence has moved from a niche theme to the central axis of both the macro outlook and market leadership. Investment in AI-related sectors, spanning data centers, equipment, and software, has already contributed meaningfully to recent U.S. GDP growth and is framed as part of a multi-trillion-dollar cycle expected to run for 8 to 10 years. U.S. companies are still in the early stages of adoption, with estimates that only around 3% have meaningfully deployed AI, which suggests a long runway for both productivity gains and revenue opportunities. For now, the United States is seen as leading China in AI technology for the first time in decades, reinforcing the idea that this Capex wave is also a geopolitical race. On the ground, the infrastructure build-out remains intense. Recent commitments imply around $2 trillion of AI infrastructure Capex over the next 3 to 5 years, and demand for data center capacity is described as exceptionally strong, with order activity accelerating and supply struggling to keep pace. NVIDIA remains the dominant chip supplier, with reported orders from parts of Asia outstripping available supply by roughly 12 to 1, underscoring how tight key bottlenecks remain. Major cloud and software players, including Oracle, are positioning themselves as long-duration beneficiaries of this build-out, even as their share prices have shown that any hint of project delays can spark sharp volatility. Energy availability is now emerging as perhaps the most binding constraint on further AI expansion. Power and water limitations are already affecting data center planning in parts of the United States, and these constraints are expected to intensify over the next 5 years as rack density and cooling needs rise. In response, large technology firms are moving aggressively to secure their own energy supply, particularly in clean and nuclear power, effectively vertically integrating a piece of the utility stack. Alphabet's roughly $4.75 billion acquisition of Intersect Power is a prominent example, aimed at expanding data center capacity and highlighting how AI demand is straining an aging grid. At the business model level, the focus is shifting from building ever larger models to monetizing them through products and workflows. Large language models are increasingly seen as commodities, with big platforms such as Apple and Microsoft emphasizing partnerships and integration instead of chasing proprietary frontier models. Market consolidation is expected, with a small group including OpenAI, Google, and Anthropic likely to dominate the core model space while many smaller players compete for a distant position. That dynamic pushes value capture up the stack to software and user-facing applications, from enterprise automation platforms like ServiceNow to consumer and advertising ecosystems at companies such as Meta and Amazon. The capital market implications are significant and nuanced. Current S&P 500 valuations are near multi-decade highs and are widely justified by expectations of massive AI-related investment, making follow-through on those Capex plans critical for sustaining multiples. Many of the largest AI investors today are profitable and generate strong free cash flow, which reduces the risk of a late 1990s-style bubble, but they still face pressure to show earnings leverage given the resource intensity of training and running models. At the same time, major private AI companies are likely to seek public listings in 2025 and 2026 as data center spending outgrows private funding, and a single offering, such as a potential OpenAI IPO, could exceed the capital raised by the entire U.S. IPO market this year, testing liquidity and risk appetite. There's a clear tension between the long-term opportunity and shorter-term risks. Forecasts that generative AI could generate roughly $1.8 trillion of revenue by the early 1830s reinforce a constructive long-run view for hyperscalers and infrastructure providers. Analysts also expect AI monetization to broaden beyond the current mega-cap leaders, potentially driving upside earnings surprises across a wider set of large enterprises in the coming year and supporting a rotation into more cyclical and non-tech sectors by 2026. Yet the AI trade is described as highly sensitive, with concerns about concentration, elevated valuations, and even AI-linked layoffs already accounting for a notable share of recent job cuts. So negative headlines on Capex, regulation, or profitability could trigger abrupt repricing. Key watch points now include actual execution on the $2 trillion infrastructure pipeline, supply-demand balance for leading chips, the timing and size of AI IPOs, and how management teams describe AI returns in upcoming earnings calls, all of which will feed directly into the broader macro and policy debates. Against this backdrop of strong growth and AI optimism, policy divergence and currency moves are reasserting themselves as major market drivers. Central banks face very different starting points, from robust U.S. demand and sticky growth to a more fragile Eurozone, to Japan's unique mix of low inflation history and deeply negative real rates. These gaps, combined with shifting attitudes toward industrial policy and trade, are feeding into foreign exchange volatility, bond market swings, and sharp moves in alternative assets. For multi-asset portfolios, the question is less about a single policy pivot and more about a prolonged period of asynchronous decisions and higher cross-market correlation shocks. Japan sits at the center of today's FX narrative. The finance minister has delivered a drumbeat of increasingly forceful warnings to speculators, repeatedly stressing that recent yen moves are inconsistent with fundamentals and that authorities have a free hand to intervene when volatility is deemed excessive. Officials have signaled that levels in the dollar-yen pair around the 158 to 162 range, especially in thin liquidity, are potential trigger zones, and the currency has already strengthened on verbal intervention alone. However, past experience shows that actual intervention has provided only temporary relief because Japan's real interest rates remain negative, so markets still see a structural bias toward a weaker yen over time, even as short-term volatility risk stays elevated. Elsewhere, relative growth and policy expectations continue to shape the dollar and rate differentials. Stronger U.S. growth, compared with the Eurozone, is expected to support the dollar over the medium term and could limit how aggressively the Federal Reserve can ease into 2026, even though the currency has recently weakened against the yen on intervention risk. In Europe, the main downside risk to growth is viewed as delayed fiscal stimulus, while persistent inflation undershoots could eventually force the European Central Bank to reconsider how strictly it targets 2%. Within sovereign debt, UK gilts are seen more favorably than French bonds due to better perceived fiscal headroom, a less inflationary budget, and shorter duration issuance, intersecting with expectations for further Bank of England easing. For emerging markets, a stable to softer dollar and a euro above roughly 1.15 against the dollar are seen as key conditions for maintaining a constructive stance on local assets. Volatility is also visible in digital assets, precious metals, and global yields. Bitcoin has fallen about 30% from its highs and is now negative for the year, with its fragile market structure and wide price swings still deterring broader institutional adoption. At the same time, stablecoins continue to gain traction, including early work on euro-denominated tokens, underscoring the gradual mainstreaming of tokenized payments even as usage remains concentrated among traders. In commodities, renewed speculative flows have boosted volatility in gold and silver as some investors rotate out of digital assets back into traditional havens, while copper's strength reflects optimism about global growth and electrification. On the rates side, the robust U.S. GDP print pushed the entire Treasury curve higher and slightly flatter, and rising long-term yields in Japan risk exporting additional upward pressure to U.S. yields, complicating the Federal Reserve's efforts to deliver a smooth easing cycle. Looking ahead, the interplay between policy divergence and the growth in AI stories will be crucial. There is a growing risk that the Federal Reserve ultimately cuts rates less than markets have penciled in, reflecting both the strength of demand and uncertainty around AI-driven labor market shifts, while upcoming changes in Fed leadership and voting composition could add noise to communications. Legal challenges to tariffs carry their own event risk, as an adverse ruling could trigger a period of heightened uncertainty before a new framework emerges. Against this, the broader macro backdrop still looks relatively benign, with supply-side, Capex-led growth, and some disinflationary forces from reindustrialization offering a cushion. Key watch points now include dollar-yen levels and any shift from verbal to direct intervention, Eurozone fiscal decisions and inflation data, the evolution of U.S. tariff policy, and how volatility in Bitcoin, gold, and the Treasury market feeds back into broader risk sentiment and cross-asset correlations. To wrap up, the data continue to point toward a surprisingly strong, Capex-driven expansion, with AI at the center of both the macro story and equity leadership, while policy divergence from Tokyo to Washington is rebuilding pockets of FX and rate volatility. For portfolios, that combination argues for close attention to the durability of U.S. demand, the reality of AI investment follow-through, and the signals coming from currency markets and alternative assets whenever the policy narrative shifts. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.